Think you need 20% down, perfect credit, or a debt-free life before getting a mortgage? I wouldn't be so sure. I'm Robert Weinberg, and in this video, I'm debunking 6 of the biggest mortgage myths holding people back from buying homes. And by the end, you'll see what's fact, what's fiction, and how today's mortgage market really works. Let's jump in. Myth number 1, you must have 20% down to buy a home. Many loans allow down payments with as little as 3 to 5% down. Sometimes we can even get that covered by down payment assistance. There are a lot of different loan options such as FHA, VA, and USDA that require little to no down payment even. So don't rule yourself out just because you don't have that much money available. I would encourage you to explore the different programs that are available so that you know what's going to be best suited for you. Again, many have very low down payment options. Myth number 2, you need perfect credit. The typical minimum credit score for an FHA or VA loan is as little as 500, and for conventional loans can be as low as 620. So you definitely don't need excellent or even very good credit in order to get a mortgage. Lenders look at debt to income ratio and credit history holistically. So if you had one late payment, but you have a good financial situation, a good reserve, you have a good amount down and that sort of thing, it can actually help to offset a lower credit score history. A quick tip for you is that if you can make a modest increase in your credit score, it can actually help you to get a better rate or a better loan program, give you better loan options during your home buying and your home search. Myth number 3, the lowest interest rate is always the best deal. That's really not the case because the lowest interest rate is actually generally the worst deal because it has the most fees, points, and extra charges. So what you really want to do is you want to look at the rate, but also the fees associated with that rate. And a little pro tip for you is to look at the APR, or annual percentage rate, when you're evaluating mortgage options, because that will help you to look at both the fees and the interest rate in one expressed rate, which is the annual percentage rate. A slightly higher rate may actually make more sense because it has lower fees. So this is something that you'll want to discuss with your mortgage advisor to see what options you have and pick the right rate for you. Myth number 4, self-employment makes it impossible to get approved. Now, there's been a lot of innovation over the last several years when it comes to mortgage programs for self-employed and entrepreneurs, as more and more people have gone to doing entrepreneurship and side gigs to make ends meet, right? So I do agree that you need some sort of documentation in order to show your income when you're self-employed. That may be tax returns, but we can also use profit and loss statements, bank statements, and things of that nature in order to show your income. I actually had a client that came to me a little over 2 months ago, and they had gotten denied from their lender, from their local bank lender, because they were self-employed and only showed a very modest amount on their tax returns for their profit. But they came to me and I looked at their bank statements. We did a 12-month bank statement review for their business, and we were able to use the deposits from their business in order to support them buying a personal home. So I would again encourage you to look at all your options and explore some of these other specific loans that are catered to self-employed. Myth number 5, you can't get a mortgage after bankruptcy. While there is generally a waiting period, you definitely don't need to wait forever. Non-QM loans allow as little as 1 year outside of bankruptcy. FHA can allow 2 to 3 years out of bankruptcy, and conventional loans 4 to 7 years outside of bankruptcy, depending on the specific program and the specific type of bankruptcy that you had. I would encourage you, if you had a previous bankruptcy, to rebuild your credit. Use some strategies like authorized user, secured credit cards, and things of that nature to set a new foundation for your credit. That's the big thing that underwriters are looking for when you came out of a bankruptcy is how have you done since? Have you been able to reestablish your credit then? Don't assume that a mortgage is off the table just because you had a bankruptcy. There are some specific loan programs that cater to post-bankruptcy borrowers. We want to make sure that we're evaluating those. Myth number 6, paying off your mortgage is always the best idea. This is a big trade-off because when you put money towards your mortgage, you can't get that money back. So it's a one shot. And even though you're saving interest, you're locking up a lot of money in that mortgage. So what you want to ask yourself is, what would you do if you needed those funds for emergencies or to buy an investment property? Do you have other money liquid? And the most important thing, and what I suggest, is to look at your total investment portfolio when evaluating your mortgage payoff strategy. And the reason why is because if you're going to take that decision to pay your mortgage in full, you want to make sure that you have ample liquidity and other investments working for you. Specifically, I'm talking about your retirement accounts. If you're going to pay off your mortgage, the first thing to ask yourself is, am I maxing out my retirement accounts? If the answer is no, then you shouldn't be paying off your mortgage. It's a simple mathematical formula. When you pay off a mortgage, your return is going to be the amount of interest on that mortgage. So if you pay a 6% mortgage to zero, your return is 6%. However, in the market, in investments and retirement strategies, the S&P 500 has generally done around 8 to 10% a year over the last 100 years. So that's where we really want to be putting our money, is into those accounts that are going to grow over time and have the ability to create wealth. With the mortgage, your return is capped at what that interest rate is. So ask yourself that question before you actually move forward with writing a check or paying that mortgage off in full. Now, these myths that we're talking about might have been telling you otherwise before, but now that you've watched this, now that these myths are debunked, you can move forward with real facts and clarity. If you're ready for a clearer path to home ownership, I recommend checking out my other video, FHA versus conventional loans. We'll dive deeper on which loan type is right for you and which is the specific one that's going to be best for your needs. Thanks for watching, and we'll see you next time.